Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. Well, we have before us the November leading indexes, and we told you when we would get December that we would show you how that looks. And when we were looking at this, is that we were saying before, with the dark green really dominating our country, that it's going to prove positive over this next 6 months. Yet, when we look at it based upon December's, a new picture arises. Take a look at this in terms of change. Back to November, now to December. This would indicate a slowing economy as we come into the first half of the year, indicating drops in terms of, look, Michigan going from dark green to actually negative growth, along with West Virginia the same, Pennsylvania slowing down, the West Coast slowing down. So that when we look at this and the Southeast along with it, is that this is worrisome. Especially worrisome when we look at the fact that we got a GDP of negative 0.1%, negative in terms of unemployment actually moving up to 7.9%. So what will the Fed do? And we keep saying don't bet against the Fed in here. What we really could see are those interest rates, which the 10-year moving up close to 2%, actually starting to move itself down as the economy slows itself down. Add to that the Fed even increasing their overall purchases of Treasury securities along with their mortgage-backed purchases. Because as Dr. Ed has talked about, this number is not good right now. This is not in the Fed's target range, and they're committed to bringing this unemployment rate down. By seeing interest rates and some of the mortgage rates moving upward, they will do everything in their power to bring rates down to keep the growth going. So when we see this, this would indicate still rates remaining low in here. So we need to reevaluate. A couple weeks ago, I talked about say no to optionality. And I want to take that another step, because you really need to look at your investment portfolios in here to say what kind of optionality, what kind of cash flows are we going to be seeing. Because if we see this type of effect of a basically low growing economy along with the Fed trying to keep rates lower, is that that's going to produce the prepayments at the levels that we've seen in here, providing refinance opportunities for people to prepay. So when we look at that, those speeds continuing at very high levels on securities. So we need to reevaluate our portfolios. So we did an example here. Here's Bank A investment portfolio allocation. Look at this in terms of CMOs. Look at this in terms of MBS, making up a huge portion of the portfolio. Then you add into that the callable agencies making up 10% of this portfolio. So you look at that optionality. And one way to look at this in terms of visual terms is to look at a total return analysis. And what we see here just visually is that this bank has risk of negative 17% if interest rates are shocked up 300 basis points. Yet, even though you don't think rates are going to go any lower, is that optionality is showing an imbalanced portfolio. So you want to look at your portfolio like this in your bank to sit there and say, how is my balance in here if these rates remain where they are? What kind of cash flows do I expect to see? But then there's convexity. And this bank has definite negative convexity in here, which is showing that risk of prepayments. Bank B, very different allocation. Here they have tax-exempt municipals. Here they have taxable municipals. Then you look at it from the standpoint of corporates, is that they have 11% of the portfolio in fixed rate corporates. This bank has a situation where they don't have negative convexity, which you can see here compared to the other bank, and you can see that it's a balanced portfolio from the standpoint of rates moving either up or down. What is the results of the two? Well, when we look at this particular bank, A is that the overall yield on their portfolio is 1.69%. And when they look at their overall gains in here, is that they're relatively minor in terms of the overall gains they have built in the portfolio. Let's compare it to Bank B. Right now, their yield is 5.85% on a taxable equivalent basis, and they don't have the cash flow problems that we see with Bank A. So once again, you need to look at, from the standpoint not only yield, but this bank has built in close to $12 million in gains. And within that, their structure going into this period after the Great Recession, and as we move through these periods of low interest rates, and the thought that don't bet against the Fed, that we could be looking at rates low for the next 2 to 3 years. This bank is set up for this. The risks that Bank A holds, what do they do with the cash? And then what kind of risks do they take with the cash? You can rebalance now. The tax-exempt market is still attractive. Taxable municipals are still attractive. Corporates on a short-term basis can be used to take in some of that cash flow and put it into more fixed-rate securities. In many cases, we're showing banks out there that they can do this without taking duration risk if interest rates head up. And that's a pretty great thing to do. So we've actually shown banks programs where, number one, they can reduce cash flow. Number two, what they can do is increase income. They can also take some gains in here in their mortgage-backed portfolio and at the same time reposition themselves for a period that we don't know how long will last, but it's going to get more painful every time we get another prepayment, another call, and once again, that optionality hurts. This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.